Unfortunately, humans respond to pain.
Welcome, everyone, back to Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well housed. I'm Jonathan Lawless.
And I'm Jeremy Potter. On Housing Insiders, we are bringing you the smart conversations with people in the know, combined with those actionable ideas that you won't hear anywhere else.
Today's episode is, in my opinion, a really important one for everyone that's listening because we've talked about a lot of different parts of the industry, but I think we all know that the industry doesn't really run unless there's a capital markets providing liquidity day in and day out. And so this conversation, again, I think is really important. I hope you all listen in and appreciate it. We have amazing guests. We have Byron Boston and Smriti Popenoe. They're both co-CEOs of Dynex Capital. It's a mortgage REIT. They've had really interesting careers. They've kind of run in parallel for a long time. They both came up through Freddie, managed MBS portfolios. They worked together at Sunset Financial Resources. But then they built Dynex into this incredible powerhouse. Byron, who serves as chairman, has deep, rich, roots in MBS trading from Credit Suisse, First Boston, Lehman Brothers. Smriti she served as Dynex's CIO for decades before stepping into this co-CEO role. Between them, they've seen basically everything you can imagine that could happen in fixed income cycles since the 80s. So welcome, you guys.
Thank you.
Thanks so much for being here. So the way that I understand how we want to kick this off is, Dynex lives at the intersection of capital markets and housing. And my first question is, what does that mean?
I will give you a very street man's view. You say capital markets, I say savers. So there's only one source of income or cash in the housing finance system, and those are those people who choose to save. And those savers will buy Dynex Capital stock and will move that cash through the system ultimately to the homeowner. So that's in the most simplest terms. I think it's very important. I use the word saver because I think it's important to acknowledge whose money that we're managing and whose money the homeowner uses to buy a house. So I believe that the mortgage REIT business model, and especially Dynex Capital, is playing a very important role for our country and society as a whole. Dynex is also built for this moment in history because, as you've already pointed out, this is a very complex global risk environment, but we have an enormous amount of history within Dynex. We're the oldest mortgage REIT. The professionals have careers. Mine spans 45 years, Smriti's at least 30. We have multiple people with 25 to or plus years experience just in this specific mortgage-backed securities, mortgage, fixed income arena. So Dynex is built for this moment in history. And I'll let Smriti continue on with more specifics. But I'm excited to be part of this organization as a result.
Great, thanks, Byron. Yeah, so the other concept I would say when you think about savers, right? Savers are looking for income, and Dynex produces income. We have a dividend yield right now about 15%. And the reason it's as high as it is because of two things. One is that because we're a REIT, we are a tax pass-through vehicle. That means we don't pay corporate taxes at our level because we distribute 90+% of our taxable income. So that allows us to pay a higher dividend. The other reason is because of the investment opportunity. The investment opportunity that we're seeing today, you can think of as happening because the US government, after COVID, stepped into the agency MBS markets with the Fed purchasing a lot of agency MBS securities. In 2022, they started to step back. And when they stepped back, there was a vacuum of investors that basically needed to come in like Dynex. And on the backs of this investment opportunity is why we're paying the kind of dividends that we're paying. So savers come to Dynex because they want income. And then the other part of the question that you asked is this capital markets and housing. We take their capital and we invest it in housing. And this is truly sort of the bread and butter housing of America. It's the homeownership that is 65% of Americans own a home. Almost half of those are insured by Freddie Mac and Fannie Mae. The proportion could be a little bit off here, but it's a huge opportunity for us to just contribute to basic housing in America, right? And one of the other points I would say to you guys is we are also very respectful of the housing finance system that we have in the US. Byron and I just came back from Europe. And, a lot of people comment to us that, we're the only housing finance system in the world where you can get a 30-year fixed rate mortgage, right? Mortgages elsewhere in the world are floating rate. They're 10 years or maybe 5 years. It's really, really incredible the liquidity that our housing finance system has. And our company literally sits at the intersection of the two, raising capital, investing that capital, generating this fantastic double-digit return.
It's such an important role you guys play, and it's funny. I often play the role of professor at my company, trying to help the young folks there, like learn about how the mortgage system works. And I always love talking about your part of the system because it's elegant, it's beautiful, it's one of a kind. And then I get into the sort of front end origination. I have to talk about stuff like appraisals, and it gets really complicated and boring. But on your side, what I'd love for you to talk a little bit about, just because I think most people just don't understand what it really means to say that you're sitting between savers and spenders. Can you talk about your customers on either side? Where are you getting loans from? And you're buying MBS securities, and my understanding is fully conventional. Where do you go to get those? And then on the other side, where do you go to get the investors on the other side?
Our stock, I'll cover like the investors where do we get the money from? Our stock is public. We are traded on the New York Stock Exchange under the ticker symbol DX. So if at any moment people want to buy Dynex stock, it's publicly traded. You can get on to your Interactive Brokers or E-Trade account and type in DX and buy it. So that's really how people can buy our stock. Where we raise capital from is really all types of investors: retail investors, institutional investors. And we go out and tell our story, and we're able to issue stock and raise money in that manner and take that capital and invest it, right? So there is a growth story here for you all to understand. Our company is 5 times as big as it was 4 years ago. And this idea of going from $500 million to $3 billion has been on the back of raising this equity capital, telling investors the fantastic track record that we have, having them believe in that, taking that money and then investing, right? So then once we get the money, we have to do two things. One is we have to find investments. Those investments are in the most liquid markets in the world, the agency MBS market. Believe it or not, it trades a tremendous amount of volume in the trillions of dollars per month, right? So it is a massively liquid market. The securities that we buy are traded by traditional bond dealers like JP Morgan, Bank of America. All these guys have trading desks that trade the securities. The pricing of these investments is very, very transparent. So we're able to find a price, and make a purchase. And then we actually also finance that purchase because we use financial leverage to generate returns in something called the repo markets. And that's not like repossessing your car, it's really repossessing the securities that we purchase. And it's an agreement that we have with lenders that say, hey, we'll put up, $10, you lend us $90, and we'll go out and buy $100 worth of something. So one of the other really cool things about the job we have is the management of this leverage. And you mentioned the experience that Byron and I have. Most of my career has been managing levered assets. So borrowing money, and for people who don't necessarily do this every day, when you go to try to buy a stock, right, you have an option to use your own money, or you could also use margin, right? So it's very similar to a margin account. So managing this through all kinds of interest rate cycles, shocks, and things like that, that's what we've done better than most, right? And that's the foundation of our track record. So we raise money in capital markets. We actually invest in the capital markets. So it's two pieces of the same pie, but it's making that spread in between.
Let me add one other piece to that, which is just emphasizing this 30-year mortgage that Smriti brought up at the beginning. It is unusual throughout the world. but it takes real skill and experience to manage a loan that has a 30-year maturity where you offer the borrower the opportunity to prepay it at will without a cost. So it's a complex instrument, and most importantly, when I say Dynex is built for this moment in history, we've got a lot of experience managing this instrument. I mean, you're talking multiple decades, 30 to 40 years of managing this instrument, and we're very skilled at it. The history is very important, but don't take that 30-year instrument mortgage for granted. It is a great asset for the United States that homeowners can borrow this period of time, but it takes a skilled management team to manage that asset over time.
Yeah, Byron, I want to tap into that experience a little bit. So, Smriti just mentioned this dramatic growth in 2023, $500 million in 2023, and now $3 billion. And that comes off of a history of pretty volatile changes in mortgage and housing through a bunch of different either global crises or very specific market moments. Can you tell us what that, since founding, walking through these tumultuous moments and then seeing this expansive growth, what does that tell us? What does that tell us about the market today?
Smriti and I have been together managing mortgage REITs since 2004. We've taken care of our shareholders through multiple market cycles, crises, volatility since that time. And we're proud of our track record in terms of managing someone else's money. And we've done it within a mortgage REIT shell. That's 22 years. There is not another management team that has managed a mortgage REIT for that period of time. You're talking the Alan Greenspan tightening cycle of the 05-06 period. You're talking about the great financial crash. You're talking about the taper tantrum. You're talking about the pandemic. So I just want to point that out, Smriti, before you just give us some more specifics.
Great. Yeah. So, guys, in '08, when Byron came to start what I think of Dynex's iteration as it stands today, he was invited by shareholders in our Sunset company that were so impressed with the performance there that they invited him to come be the architect of this version of Dynex that you see today. Byron and I always talk about '08 as a very interesting time, not the least of which it was a financial crash, but we think about it as like in '08, boom happened, right? Boom happened. There was a lot of fallout, and for the most part, like if you had capital and you had investment capital to put to work, you could find things, and they were really cheap, right? Because there weren't necessarily buyers for the types of risk that had imploded, right? So that was one era of Dynex where I would say 2008 to 2013, picking up the pieces out of the financial crash, really having a diversified portfolio, being able to generate amazing returns in that time period. And then in 2013 to about, I would say 2020, life shifted, right? So the Fed had done QE, liquidity got poured back into the system. We were still doing the zero interest rate situation, and things started to stabilize. And so you had I would call it a different set of risks and opportunities at that point. About halfway through there, we started to think about global risk, and we've always thought about global risk because we're a top-down global macro shop. In about 2016, we started to see like a lot of different things happening around the world where we felt like our shareholders would be better served in a liquid, flexible investment strategy. So in 2017, we started to sell all of our credit assets, move into agency MBS, and have more liquidity and flexibility at hand. The other thing we did was we split our portfolios between agency RMBS. As Byron mentioned, there's a prepayment option in there, so it can be kind of risky when rates go down or rates go up a lot. And then we paired that with agency CMBS, which are really multifamily loans that are made on apartment buildings, right? And those tend to be structures where there's a 10-year final maturity. There's preventing people can't actually prepay. There's a penalty for prepayments. And builders and apartment operators really like that because it's like 10 years worth of mortgage, and then I get to pay it off or refinance it at that 10-year period. The combination of these two things was a fantastic diversifier for us. So between 13 and about 2020, our investment strategy was really focused on those two aspects. Now, 2020 was like a banner moment for Dynex. Our thought process, top-down thought process, really helped us get through COVID. And when I say COVID, I mean like literally March of 2020. So March of 2020 and the year 2020 in general was among the best return years we've ever had. So our management of that was exceptional, right? And now you ask the question, like, what does this mean for investors today? Now, fast forward all the way, we went through a massive hiking cycle where the Fed took interest rates from 0 to 5%. That type of hiking cycle has not been witnessed in the United States since the 70s, when Paul Volcker was the chairman of the Fed, and it was to deal with the inflationary impacts of COVID, as you guys all know, right? So now here we are. We're standing here past all of that information. Amazingly, the agency MBS market still offers a fantastic return for our shareholders, right? And it's still the most liquid market. It's still the most flexible market. And we feel like our capital should still be invested here. Now, while all this has happened, you've got other developments like private credit and now obviously like all the AI hype, right? So those things have been happening alongside, and we look at all of that stuff to say, is this still the best investment opportunity for Dynex shareholders? And when we think about the through the cycle returns, like really what ends up happening when you use financial leverage like we do, you can't just think about what your return is today. You have to make sure that the return holds up through varieties of shocks and cycles. And we felt like the credit markets just don't hold up as well over time.
I could listen to this forever because I love geeking out on this stuff, and I know a lot of our listeners do too. And I want to ask maybe a one level down question in terms of how you've managed through those cycles. So you mentioned both sort of a single family and multifamily mix. At some point, maybe I'll ask you how those end up hedging each other in some ways. But just focus on single family for a second. When I think about single family investments, you're not really taking credit risk per se because it's guaranteed by the GSEs. You're obviously taking interest rate risk like any bondholder would. So, rates go up, your bond price goes down, rates go down. And then, of course, with convexity in the mortgage world because of prepayments, that kind of becomes a second risk, which is like, how do you anticipate the prepayment risk? So interest rate, prepayment risk. And then I imagine there's a third because the MBS also has a spread to treasuries that also changes due to other things like political risk, like uncertainty of like what's going to drive the future of the GSE. So like, am I pointing to the right things that you guys think about in terms of managing the overall risk profile of managing at least the single family side of the business?
100%. So you've got all of them there, and I would add one more, which is the ability to finance those MBS in the short-term financing markets. So we're taking capital, we're financing the assets, and then we're investing. We're also investing in those MBS. So yes, the life of a 30-year mortgage is unpredictable, right? So people have low interest rates. They want to keep their mortgage forever, right? And that's been happening. You've had this lock-in effect of all the low-rate mortgages that were originated between 2020 and 2022. So those mortgages are still here. And then when rates go down for mortgages that have been originated at higher interest rates, people want to lower their mortgage rate. So you have to be really good at understanding the probability that mortgage rates are going to go up or down, right? So that's a huge part of what we do. We have models that help us understand, how the cash flows of the mortgages will change with changes in interest rates. And that's our expertise.
That's amazing.
Right? It's huge. The second piece that you mentioned, really important, is this idea that when interest rates do go down, like what do you do, right? Like how do you manage this risk? We use hedges, right? So we have hedges that basically say, look, we want actually to earn the return from the yield on the mortgage-backed securities we buy, and the yield on the hedges that we put on. So we're actually looking at the spread that you mentioned, spreads to treasuries or spreads to, we actually use interest rate swaps. We try to earn that spread. And in doing that, we actually substantially reduce the volatility of our returns relative to interest rates. So one thing people get wrong about mortgage REITs a lot, they just think we buy more MBS and we finance them and then we're stuck with the interest rate risk. We're actually actively managing that interest rate risk to such a great degree that we try to minimize the fluctuation and just try to earn that spread. So today that spread is like 150 basis points. And because of the use of financial leverage, let's say it's like 8 times, and you're getting a return of like 15 to 17% when you do that. And we try to keep that return as close to home as possible.
So I'm going to ask just a quick follow-up question, maybe to both of you, just a quick answer. Okay. You wake up in the morning, you check the World Cup scores for the games that happened at 10 o'clock. What's the next metric you're looking at? What's the next thing that you want to see in the morning?
Where is the yield on the 10-year treasury?
10-year treasury.
Same as Scott Besson, where's the 10-year?
Now, I will look at that. I'm going to be a little more high level because I believe the globe is evolving in a manner that none of us really understand where we're going. I search for, has there been a definitive moment, change? Have any of these factors been definitive? It would be similar to, if you go back to the great financial crash, 2004, 5, and 6, it was building. But then it started with early payment defaults and subprime. So that was a definitive moment that this was now about to finally change, or boom was about to happen. So I'm at the macro level because we're teammates. Smriti is playing. What I always tell people, I say, Smriti's the quarterback on the field, and I'm on the sidelines as a coach. And so I'm thinking one level higher for at the macro level. I almost stay there at this point in time in our team approach to the business. There are a lot of evolving factors. There's something in our future that's going to surprise everyone in the capital markets, and in fact, I'd argue everyone in the world, but we don't know what that happens to be. But that's why I emphasize our skilled experience, because it's very necessary for understanding the future, having a solid understanding of history. And so I will stay one level higher, looking for that larger macro event that may be definitive.
Byron, when you see that, after you call Smriti, can you call me and just let me give me a heads up?
So we're talking about clarity and making a full picture understood to your savers, your team, and the market. I'm curious what you run into that people misunderstand. What does the housing market misunderstand? What do savers maybe misunderstand? And maybe we could do one of each.
One of the questions we get a lot is, why do you pay such a high dividend yield? If you pay that kind of dividend yield, there must be something wrong, right? And the markets are conditioned. It's really funny. When you introduced us, you said, we're mortgage REIT, and that in some circles is like not a great company to be, right, over time, because they're associated with volatility. There's been a lot of headlines about mortgage REITs over the years, right? So I think the thing people don't necessarily want to focus on is, okay, if you're paying a high dividend yield, why are you doing that? And today my answer to them would be 2 reasons. One is my tax status as a real estate investment trust. 2 is the function of the investment opportunity I just told you. There truly are these returns available to investors. I've been in this market for 35 years. If you had told me in 2022 that the investment opportunity would be a 5-year plus opportunity, I wouldn't have believed you, right? So the structure of the housing finance system today is creating this opportunity. And so a lot of people don't understand that piece, Jeremy. I think, and so that's the savers part. Yeah, when we were preparing for this podcast, something that we talked about really struck me, which is the investor is the person in this pipeline that is forgotten about. A lot of people talk about, oh, this is good for the consumer, this is good for mortgage bankers, this is good for the risk in the banking system, blah blah blah. But they forget what Byron started this whole thing with, which is the only person who has money to put to work here, people, is the saver, right? And investors like ourselves. So we're taking those savings, we're putting the same. So a lot of times we will find proposals like, let's create a permanently refinanceable mortgage or whatever else. You can do that. However, that comes at a price, right? And the markets will price that, and you are not probably going to get the benefit you think you're going to get. So the investor is often the last person considered. And as a result, Byron and myself, we work with groups like the REIT, which is a great organization representing REITs. We work with the MBA, the Mortgage Bankers Association, to make sure our voice as the ultimate provider of capital is heard.
That's really important. What Smriti just brought up about the investor. When we were at Freddie Mac and Fannie Mae, while we were at Freddie Mac, I was amazed at how they took for granted the investor. The agencies, they call the originators their customers. And yet the people who own the risk and hold the risk the long term were Smriti and I and our team. Bonds have matured in the portfolio of Dynex Capital. And if without the savers, the money doesn't exist in the system. So the most important people are those who are putting up the money, and then those who are trying to take care of their money, which is where the mortgage REIT structure comes in. And then what do savers get wrong a lot of times? They just trust their money with the wrong people.
Oh
I've
gosh.
watched this and I've studied Charles Ponzi. I've studied the 1920s. I've watched, they just simply trust their money with the wrong people, which is why we try to lead with, we want to take an ethical approach to managing your money. We fully recognize this is not our money. This is someone else's money, and we take it very seriously that we're managing someone else's money when we sell them the stock. We want them to understand that we too own the stock, Smearty, myself, and other managers in the team. So we're in the same boat. But so often the savers get it wrong in terms of who they choose to leave their money with.
I just want to emphasize something that you guys just said, and just be very clear about it, because being at Fannie Mae too, I totally get the point that people forget the investor. And certainly you also said like they think the investor's making too much money. Like, why are you making that much yield? And I think what people forget is if you decide we're going to go in and make every loan portable, or we're going to make every loan assumable, or we're going to let loans be modified to 50 years, there's a whole group of investors that are going to just take their stuff and go home. And they have alternative investments, and people just don't realize that like it's not as simple as saying you don't deserve this return, or you should be okay with us doing things for consumer. Like, at the end of the day, there are a lot of other investments out there, and if you disrupt this market, they're going to go to those investments instead of this one. And portable might sound great, but at the cost of the entire system, it's not a great alternative. So I'm so glad you said that, and I think it's so often misunderstood, and I just think for our listeners to just really understand that that's an important part of the market.
It is, and what I think is not appreciated as much is capital markets exist to price risk. If you want to have a portable mortgage, I'm happy to price the risk. You're not going to like the price, right? So
Right.
in bond trader world, we say no bad bonds, just bad prices. So that's kind of how we say it. And so there's a price for every risk, guys. There's a price for a portable mortgage. You're just not going to like the price that the investor wants, because you have to compensate investors for the risks that they're taking. There's no free lunch on risk.
That's right. Smriti, it also sounds like you're talking a little bit about the fundamentals of the dividend and the investments and the experience of the team, as well as the emotional side of the saver, but also of this 30-year fixed and this really innovative housing finance product that we have. Maybe this is then a good time to talk a little bit about Dynex and what else differentiates you, this kind of experience and emotional side of the story. The thing that I was curious about is you talk to the team and you talk about your values. What's the mix of what we would think of as the fundamentals of Wall Street versus the values and some of these other things, the story of home ownership? How do you manage that? How do you talk about it at Dynex?
Everything starts here with our core values. Okay. We have 4 core values at Dynex. We are kind. We are curious. We deliver value, and we build trust. So and Byron and I have used this structure from the time that every time we've worked together. We've sold stock to public investors. They have trusted us. We have built trust. We have delivered value in the total shareholder return and economic returns that we have given to shareholders, right? We are curious, and this one I love, because what it is the ability as a macro investor to never allow yourself to conclude that you know something. The moment you know something or you think you know something, you've cut off the possibility of learning, right? So I really focus on this with my team. Say, try not to conclude. Whenever you say something, make sure you leave yourself a little bit of room to say, like, I could be wrong. I could have there could be a mistake here, right? So curiosity is like a huge one for us. And then the kindness part is truly this, what you're talking about, which is the intersection of saying, I recognize this is not my money. This is the money of somebody else. Somebody is trusting me with this money. I take that in every action that we put together. Why are we investing? We're investing because we want to generate a return for our shareholders. That's what we care about. Not that we don't care about others, but that is why we're here, right? Like, we're here to generate this return on behalf of our shareholders. The kindness part also comes in how we treat each other inside the company and how we treat everybody else outside the company. So we don't believe that it is mutually exclusive to earn a great return and be a great company and be good people. It's not mutually exclusive. As much as people would like to think that, I don't think it's mutually exclusive. It is possible to do a great job for your shareholders and be a wonderful human being. And being good human beings at the end of the day, I think, is why we have been able to generate the returns we have generated. When you start the day with in your heart, I'm caring for something, it makes you make a different set of decisions.
I always say, for businesses to thrive through multiple cycles, you need to have a good business, but more importantly, you need to have a good culture that allows you to protect that business, but also evolve with the times. So I love those 4 pillars. I hope a lot of people take that home, because if you're kind and curious, I think those 2 things alone are going to make you a company that can really, really survive. I want to take a quick break. I hate taking a pause in the conversation, but we'll have a word from our sponsor. And please, 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 sponsors are what allows us to make these podcasts and talk to incredible people like we have today. So listen in. If you also want to be a sponsor and be highlighted in this sort of segment, please, please let us know. Okay, welcome back. We have had an amazing discussion about the role of capital markets and Dynex, so on and so forth. It's been a great conversation, but now I kind of want to start looking a little bit more forward and thinking about innovators and what's changing in the market. And so maybe to just put ourselves in context, we're sitting here in the year 2026. It's been a wild ride in housing. We have a housing piece of legislation that's sitting on the president's desk as of today, unsigned. But I just want to hear from you guys, sitting where we are today in 2026. What are some of the big changes that you've seen, like right now, that are happening right now? And what are some of the things that you're anticipating and how it's going to affect your business sort of in the short-term future here?
Wow. I'm going to start with a very big picture thing that I believe is an issue globally. And that is the issue of income inequality, right? And I say this in a very dispassionate, observational manner, right? Income inequality globally has risen a great deal. And with it comes some consequences. Some of the consequences we are seeing in our country today directly affecting the housing market, right? So the ability of someone to earn a wage that's sufficient to support 30-year fixed rate borrowing to own a home, right, has been circumscribed to some degree by whatever forces, right? I'm just saying the fact is income inequality is impacting a general individual's ability to borrow and own a home. So that is a huge part of how we think about, that percolating through the system. So we look at income inequality. Above that is another piece that Byron and I often highlight in our macro discussions. It's the concept of human conflict, right? And that sounds a little bit scary, but the fact is, like, humans have been in conflict since the beginning of time. And once you accept that as a human being, you're like, okay, yeah, the humans are going to be in conflict, but the amount of humans, so in this day and age, these are some stats that really blew me away. We have 8 billion people on the planet today. When I was born, there were 2 billion. All right, so it's 4 times as many people. And then 100 years ago, it was much less than that. I think it was like 1 billion or less than a billion, right? So if you think about the amount of proliferation of human beings, there's obviously going to be competition of resources. And as a result, we're seeing the kinds of things that we're seeing. And in general, the human beings that we have on this planet, we are somehow we like hierarchical systems and power concentration. So that's the other piece that we focus a lot on. Why is all this relevant to Dynex? We've talked a lot about government policy driving returns. And that has been true since 2008, right? Government policy got us out of the '08 crash, and we haven't been able to really get away from that, and we're still in it. So a big part of how we think about what's coming is, number one, start from this idea of like, where's the conflict? What is the power dynamic that's being created? What are the policy implications of that? And then we apply a very disciplined process. We have a 4-pronged process to analyze our investments and hedges and risk. It's fundamentals. So what are the fundamentals in the market? What are the technicals? Where's the money going? Where's it coming from? Psychology, sentiment. Are people bearish? Are they bullish? Are they scared? What's going on? And then finally, value. Where can we find value? Right? So fundamentals, technical, psychology, where's the value? But this overarching thing of policy, it's something that Byron and I have been focused on. I'm going to say like since 2011 or even earlier, right? Knowing
Right.
that this thing is gonna be out there. So we see a lot of government policy shaping things for our business. The other piece is technology. Everyone's talking about it. We're massively focused on, and I truly believe AI is a seismic shift in that's going to cause a lot of disruption for humanity in general. Not in a bad way, right? Like disruptive things have happened. The steam engine happened. A lot of horse and carriage guys got put out of business as a result of the invention of the steam engine. And then it started the industrial revolution, right? So many things in technology, I think we're in that kind of a moment. As CEOs, we are intensely focused on the ability of these things to create like these enormous shifts. And, managing other people's money means you got to be ready for these things. So these are a couple of the really big things that we're focused on.
As my generation ages, the need for income, which ties back to her point about the income inequality, the huge shift in terms of wealth in the world. The need for income is going to grow exponentially. You go 5 years from now, 6, 7 years from now, the world has never been here. 8 billion people on the planet with this many people in the older age ranges. And so what we understand is what we're doing is so important because this need for income. There are investors who are going to ultimately say, well, you know what? I don't want to buy SpaceX and pray for some return. I would just prefer getting a check every single month from Dynex Capital, especially as they age, especially if they go through some type of market correction and they see their portfolio adjusting. So this is one of the largest trends that really starts with Smriti's first point, which is the income inequality. There are those who truly need an ethical team of professionals managing their money, and the return simply be a check every single month.
I think one of the things that we always have fun with on the show is like the crystal ball type questions, but the reality is that we don't have a crystal ball, right? And so I can't ask you to look 5 years from now even, but what I think you just said, I've heard it said, I should say, that demographics is destiny, and that's kinda what you're talking about, right? There's just a truism about the
Big.
demographics. Do you have a sense of a policy shift, a policy recommendation, a policy tweak even that would address some of the demographics that you just mentioned that housers should be thinking about or policymakers should be thinking about?
Unfortunately, humans respond to pain. Everyone knows the Social Security system is in trouble, but it's only when we get to the brink of the cliff, unfortunately, that politicians will try to do something. Humans respond to pain. That's an unfortunate thought, but it's for real. And so, again, we believe our role is very, very important, generating income. And simple as it, there will be some pain, and we our intention is to take care of our shareholders' savings such they still get income even in the painful time. So, Smithy, that's very high level. You go with more specifics on it.
I mean, the idealistic part of me says, start facing up to the real problems that we have in this country with respect to our fiscal deficit and our obligations that we've basically given to people that are expecting Social Security, right? If we can discuss this as reasonable human beings and solve these issues, that's a long way, going a long way towards solving what I think is coming. Some easy things policy wise, and I say easy just because it's so hard to get people to agree to anything, would be to kind of to think about ways in which baby boomer, that generation that owns a lot of housing wealth, how can you ease that wealth transfer to the next generation somehow? Is there a tax credit or something that allows them to liquefy their homes without having to pay like massive amounts of capital gains tax? Easing that burden, I think, could help grease the wheels of the housing shortage in the US. Also, maybe any kind of like generational transfer, if you transfer the thing to your children, if there's a way you can break sort of the tax burden on that. I think those things are simple things we could do. They would need to be paid for, obviously, but I think there's a benefit in terms of just creating the volume that could help.
Those are great recommendations, and I want to. I mean, Smriti, you sort of initially laid out sort of like what's happening in the world, challenges. I even think demographically now it's a really challenging point in time too. We just don't have as many young people coming into the system. You look at other countries who experience this and like the policies that you just sort of outlined on how we might address it. All that stuff is scary, so I want to ignore it for a minute and talk about sort of the other thing you mentioned, which is sort of this sort of techno optimism. Like I mean, AI is just amazing. It's incredible what it's doing. The promises of curing cancer and things like that haven't quite come about, but like it's not something that would surprise us if that happens in the next 5-10 years as a result of what AI can do. So I want to talk about AI in the context of your business and how you're using it. There's also, I've heard a lot of people say, one of the things that UMBS should do differently is leverage technologies like blockchain, flow more data through to the investors so things could be we've seen Figure do that in the second lien market. So anyway, blockchain's like an old school version of like technology now. You've got AI. I'd love to hear from you guys. Like, how does that influence your platform? Are you a little bit more recipients of like how the primary industries leverage technology and then you adapt it, or are there ways that you can be a little bit more leaning forward into some of the changes that are coming?
I think it's a lot. It's all of it. It is all of it. So when I think I think of it in terms of like offense and defense, right? Given that I work with a guy that played football and is a football nut his entire life. So the offense defense part, right? So I'll talk about the defense part first. I'm on the board of our company. We're publicly traded, and we've just talked a whole bunch about how we're taking care of our shareholders, right? AI and the way these frontier models are today present a substantial increase in the quantum of risk globally. The ability to hack others, the ability to do malicious things, all of that is higher. So as a CEO, I think about like how do I employ AI to help me defend what I already have? So can it help me play defense? Right? So that's first. The second part and this is really interesting. I just came back from a conference in Europe last week, and the morning that I showed up, Monday morning, the Friday night, the administration had cut off access to Mythos and Fable 5 for anyone who was not American. And I truly, first off, walked away from that conference saying, "Thank God I'm American." But but also just the reaction of Europeans, Australians, other people that were there saying, oh my God, my company is full bore implementing AI, and I had not considered that it could be cut off, right? So I'm an American company. We're running, we're in America. We're investing in American, the American dream. How should I, as a CEO, be thinking about embedding this into my processes, my functions, when there's the possibility that it could get turned off? So I do think about that risk as well. So there's a defense part of it that says, yes, it's wonderful, it's beautiful, it's amazing. Now, how can I be strategic about actually implementing it, right? And the third defensive part is actually in our investing strategy. So as the mortgage market has really been dominated by non-bank originators and servicers. The name of the game in the MSR space is retention, and the ability to kind of retain your borrower, retain the MSR onto your balance sheet, and the ability to deploy technology to get that refinance happen as quickly as possible using AI has substantially changed. So that what that does is it actually changes the prepayment response of our investments, right? So our investing strategy has to account for the use of AI and the speed with which these borrowers can refinance. So that's all on the defense side, right? So we adjust, right? Like we buy specified pools. We try to have different kind of hedging strategies for when interest rates go down. All of those things are ways we've adjusted, right? So that's on the defense side. On the offensive side, like this is the fun part, which is probably the part you guys really care about. But offensive part, look, I was a very early adopter and user of ChatGPT when it first came out. I give credit to my son who had just graduated from Syracuse. Within a few months of his graduation, ChatGPT comes out. He's like, "Mom, you got to do this, otherwise you're going to get behind." And wow, like it's changed his career, but it's also helped me as the CEO stay on top of a very important technological development. So it has changed the game for us in mundane things, writing presentations, figuring out problems, doing Excel things much faster, all of the basic blocking and tackling, right? And where we are strategically with it now is figuring out how it can change the processes that Dynex actually has in place. And one of the cool things about building a company in this day and age, by the way, like even 6 months ago, I probably wouldn't have been able to tell you this, because of the developments and how quickly the AI process has come about, we can actually start to, generation skip technology, because as we're growing, Dynex is building this operating infrastructure, which can now incorporate AI and automation in the building blocks, right? And the one thing that keeps me from sort of saying full bore go for it is the defensive part. So there's some of these things are evolving, and so my strategy has been to simply say, this is great. How do we cleverly balance the line between offense and defense? I think every CEO out there is trying to do the same thing, and it's tough. It's tough, and because the stuff is moving faster than you think, and when I think of like other times in the world when we've had rapid development of technologies like this, the one that comes up for me a lot is, the arms race and the nuclear race, and how that eventually like changed a lot of technologies in the world and the profound impact it had on human beings. So I'm pretty cautious, but also optimistic about how this is going to affect us.
Yeah, I have one quick follow-up on that, because that is a fascinating way to think about all the things you have to juggle and deal with managing this. And one of the ones that we didn't mention earlier, but comes to mind in what you said, which is the speed of the game also means the speed of data and communication, right? So an example I like to use is you could see property values increase in Austin, Texas by 30% a year over year for 3 years in a row. And then they'll go down 3% in 1 month, and you'll get a headline that's like housing prices crashing in Austin, that ignores the last 3 years and just talks about the previous month or something like that. And I'm curious, with that in mind and what you just said about the speed of the game, is property risk the house itself, the actual physical risk to the house come into play in that model? And how do you think about that piece of the collateral, knowing what we talked about with mostly interest rate risk and how you manage the expectations of the market? Where does the house sit in the holistic view for you?
What an awesome question, because I think this is the magic of housing finance, okay? The way our housing finance system is constructed, it tells you as the GSEs are in, for Smriti, the investor, Dynex, the investor, we are almost told that you shouldn't care about the individual home, right? They're all generic, they're boxes, you can do an automated valuation of one house versus another house, and you can do that in some places, but not every place, right? So as a GSE investor that's invested in guaranteed securities, you can think that these things, one thing is the same as the other thing, and we're encouraged to believe that. Reality is very different, right? And by the way, this is one of the reasons why we are very circumspect of taking equity risk in the residential space or the commercial space. Commercial space is actually a little bit easier to underwrite because you can see the building. There's only one building and you can check out the tenants and it's much easier. But imagine like having to underwrite all these properties, right? And which is what Freddie and Fannie are currently doing. So we've delegated the underwriting of these properties to them. I will tell you guys, they are not the same. They're not the same because they are this is obvious, they're in different geographies. The demand supply process is different. The climate risk associated with each one of these things is different, right? So at the end of the day, even as an NBS investor who's sitting above that risk, we think about things like the prepayment risk if a hurricane should hit a certain place, and the GSEs actually pull the loans out of the MBS. So we are forced to think about those types of things in that way. And what I would tell you is risk transformation is not a clean process. You'd like to think that it is, right? But it is not a clean process. So there are risks here that I think need to be fundamentally understood when you're taking credit risk as the GSE themselves. I know they know this, right? Like it's the individual home actually does matter a lot. But when you're doing it at scale across the entire United States, you can say, well, maybe the stuff averages out. But the reality is that there's a lot of bespoke risk that's kind of sitting in there.
Thank you. We have some wrap-up questions, and we really appreciate the time you spent with us. So, John, why don't you kick off our wrap-up questions, because I could keep this conversation going all day if we weren't forced to stop.
I know. I'm sad that we have to move on to wrap-up question. I'm actually going to change my wrap-up question a little bit from what I was planning on asking, just because we spent a lot of time talking about the single-family market. And Smriti, you just mentioned a little bit about multifamily. So I just want to ask you a general question, and you can take it whatever direction you want. But in the multifamily industry, in terms of technological changes, demographic changes, it's hard to think about how that flows through to the securities that you ultimately invest in. But is there anything on the multifamily front that we haven't talked about that you think is like a burning issue in the multifamily space?
So I'm not going to talk about it in terms of a burning issue, but multifamily housing can solve a lot of our housing supply problems in the United States right now. I truly feel like it's a underappreciated way to live. Most of the world outside of the U.S. like actually rents their home, and our society, given the income inequality and things that I've talked about, may actually be moving to a situation where multifamily housing is sort of like the way people get housed in the future. So I think that shift is actually happening slowly but surely. The idea of what things could happen in multifamily housing that's exciting to me are things like sensors and monitors and ways of understanding what's happening in individual buildings, where it makes it much easier to manage these properties, and property management costs actually go down. The use of technology on site, I think it has not yet fully come to pass, the benefits of doing that. It takes some investment, but that's a hugely exciting process for me. For us in Dynex, the reason we invest in multifamily securities is truly because the structure is so complementary to the convexity of the agency RMBS. It's a really nice balance. And as we spoke about earlier, like no bad bonds, just bad prices. The prices just aren't there for us to make massive allocation to this sector right now.
If you think about what we said earlier about the demographics, multifamily housing is a very important element, and so often it's just, I think what Smriti was alluding to, it's overlooked. And so the ability to assess that risk, and when we've had it, if you look at us when we came into this decade, probably added on Smriti, 40, 50% of our book was it was an agency book of business that we had developed over time, but a good chunk also had multifamily, which really diversified the convexity profile of the book. So it's very important. Simple as that. We just tie it back to the demographic challenges that we mentioned earlier, 8 billion people on the planet. And then the need for income. If I were to sit with an investor, I'd say, we're generating our income from an instrument that has a government guarantee backed by U.S. real estate. And that U.S. real estate could be a single family home or it could be a multifamily property.
Right on. We've uncovered so much insight and clarity today. We also like to uncover some of those innovation questions or some of those out of the box questions. And so I like to ask one. I kind of joke sometimes it's a hot seat question, but the reality is like you have such a vast experience and an ability to see across global markets, these global issues, the US housing market. I'm really curious, with that experience as co CEOs, if you were not leading Dynex, what would you be working on? What problem interests you? What would you or what do you wish you could spend more time focused on? Byron, I'll start with you and then ask Smriti the same question.
All right. So I am an economics nerd. I love it. I view economics as the study of human behavior. If I went back to college, I'd create a major that included economics, sociology, psychology, right, and some government, right. At the end of the day, I'd be studying humans. So I've often thought about, can I study humans after I've been a human for 7 decades? At the end of the day, capital markets, it's a group of humans that are transacting with each other. And the more you know about those humans, the better opportunity you have to predict where the next price movement might be. So I have a ginormous interest in humans. I've studied I continue to study history, and the history helps me stay calm and thinking about what humans may do next. When Smriti says policy risk, at the end of the day, the policy is created by humans, period. Plain and simple. Interest rate risk. Well, this buying and the selling is conducted by humans. So our largest risk is probably going to originate from humans, as it has throughout history. So if you ask me, boy, I'd love to go back to college after 70 and study humans after being a human being for 7 decades.
I love that.
So I'll tell you what interests me now, which I already do, is coaching and mentoring people. And I'm a big believer in changing the world one person at a time. I'm a big believer in, and I'm very passionate about getting people to love each other and get along with each other. So that is really a personal mission of mine. So if I can change one person's opinion, if I can shift one person, towards loving other humans versus not, I think I'm contributing. So that's my number one thing. My second piece, guys, is about teaching critical thinking to people at a young age, to young children. I think a lot of what has been lost in our education system globally has been this idea that you can think for yourself. And I'm very, very curious. I'm spending a lot of time actually researching what is it that we've lost in terms of our ability to think critically, and where should it be taught, and at what age should we be teaching it, and what are the aspects of it that we're going to need, by the way, in an age of AI, which can do some amounts of critical thinking, and maybe eventually it can, but you are still going to need as a human being to be able to discern for yourself what is the truth, what isn't the truth, what do I like about this, what do I not like about it. That is, I think, one of the most important burning issues of society today, and I'm really excited to work on that.
At Dynex Capital, we believe in developing our people. So we both like coaching our team and developing it. And the best thing that we can do for our shareholders and for the housing finance system is to develop another generation of very skilled professionals in managing the U.S. housing finance system assets.
Hear, hear. Thank you. That is quite the vision, and I really appreciate it. I feel in this conversation inspired, John, by everything we heard. So we really appreciate your time. We know how valuable it is, and sharing this definitely ties together the housing ecosystem as we talked about, but then also spreads the word, I think, to a group of people who want to understand this better, who want to invest in it, and who want to understand how to become a part of the system, as you said. So that to me is really cool. I can't wait to share this episode broadly. This has been a
Yeah.
real pleasure.
And I'll say that your last answers there just, I mean, really reflected a wisdom that you guys have developed over the years. And I think what's really cool is I think Jeremy and I are convinced, and I think a lot of people do know this, but a lot of people don't, how important the role that you guys play in the market is of connecting savers and, just keeping the liquidity running in the market. But you guys have connected that to like a true study of humans, like of what it means to be people. And the fact that, even on the verge of AI, we just can never lose sight of the fact that this is a very human business. And so we've somehow managed to make capital markets and investing a sexy and fun and cool topic to talk about. And I really thank you guys for the opportunity to chat with you.
Thank you.
Thank you very much.
Well, that will do it for today's episode. As always, we invite comments, questions, suggestions for topics, so on and so forth. If you email us at podcasts@thehousinginsiders.com, we would really appreciate it.
And if you believe that everybody should be well housed like we do, share this episode widely and reach out to us for guests and sponsorships. Thank you, as always, to Keenan Chen for our music.